Greetings, it's Charles Thomas from Intrepid Eagle Finance here to talk about what happened during the third quarter of 2025 for the markets and the economy. Looking first, let's talk about glass half full observations we made. The global stock markets continued their upward climb in the third quarter. Good news across the board there. We love to see that. Near-term recession risks can continue to fade to the background in the United States. United States GDP for the second quarter was 3.8% and is expected to be similar for the third quarter. And the Fed lowered interest rates for the first time in 2025. Now, looking at some of the glass half empty things that are taking place, labor markets are showing signs of softening. The Fed's preferred inflation measure, called core PCE, continues to be stubbornly high, around 2.9% compared to where the Fed has their target at 2%. Spending around AI related ventures is very robust, but the future revenue is not shown up as of yet. And then Q3 ended with a shutdown of the US federal government, which is, as I'm recording this, continues to be the case. Let's look at a few numbers that popped out to me for the second quarter. 4 to 4.25%. That's the current policy target range for the federal funds rate from the Federal Reserve. It's one of the biggest indicators of interest rates in the United States. Has implications for long-term rates for businesses and consumers. 211 billion. That's the cumulative amount of capital that estimates have been spent on artificial intelligence projects. That's a mind-boggling number. So far, markets have been very positive around that, but eventually the profits are going to have to show up for that. 0.11%, that's the average S&P 500 index performance during federal government shutdowns. We'll talk more about that in a few minutes. And 12.6%. That's the year-to-date return of a portfolio consisting of 60% stocks and 40% bonds. In other words, a lot of the headlines so far this year, even despite that, globally balanced portfolio, both stocks and bonds, is just about in the same range as the S&P 500. So a lot to be said there. Let's talk about resilience. Now, there's a lot going on this chart, so let me tell you what this is looking at. So the black lines are economic growth, or in some cases, the lack thereof. The colored parts of those bars are what contributes or what detracts from the economic growth. And a couple things I'll just point out that I noticed when I came across this chart. One is that light blue part of the bar. And how consistent that one is, that's consumer spending. That is just how much of a consumer-based economy we have. And it's been very consistent over many quarters for being a positive contributor for the economy as a whole. The other thing I will point out here is if you look toward the right, toward more recent quarters, the purple. Is very interesting. You see that shift from being below the line to very far above the line. And that's the shift we made this year from being a net importer of goods to being a net exporter of goods. That has been very much in the headlines this year, and that's been this huge shift that we've seen from the beginning of the year to where we're at right now. Whether that'll continue or not, for the long term, we will have to see. But in the short term, definitely a big shift from some of the policies that have been put in place this year. Let's talk about some interesting things we're seeing out there with some of the biggest companies. So there's this title that we've seen applied called the Magnificent Sevens to the seven biggest companies in the US stock market. Names you've heard of like Apple, Amazon, Google, and so forth. And a couple things I'll just point out to you that this very big chart tells a story about. One is just how much money these seven companies are spending on capital expenditures. Remember, capital expenditures, that's not legal pads for the office. These are big, large scale projects that these companies are investing in. They expect to get a long-term return off of. A lot of this for these technology companies is driven around investment in data centers and other infrastructure related to artificial intelligence. There's a lot of money going out for that. Um, for 2025, it's around $300 billion have been spent. That's around 1% of the entire country's economic activity for the year so far, just on this one thing. Pretty phenomenal. And if you look at the bottom half of this, there's a comparison with that spending compared to cash flow of these companies. And my takeaway when I saw this is just how much they are reinvesting it back into future revenue. They're not just sitting around on their laurels, especially if you want to pick on Google. They could probably have a very good business for many decades if they just had that search box that we all use every day. They're choosing to take a lot of that money they're making and plow it back into these big long-term projects. And it's not just data centers. There's downstream effects for this as well. A headline earlier this year had talked about how Microsoft was investigating nuclear power for the first time in a long time to power some of their projects. So there is big spending that's taking place from this. What that will yield in the long term, we'll have to see, but it's definitely notable. And we always want to look at the labor markets and what that looks like. And what this chart is, let me tell you what it is and what it isn't. This is not employment levels, it's the rate it's the rate of hiring that we take place. So, although unemployment itself is not down per se, the rate that businesses in the US are hiring has slowed down relative to the last couple of years. Now, there were some revisions that came down with prior month's job gains, meaning that labor market, it's weaker than it was entering the summer, and companies hired less than expected, showing that decline over that 3-month average. When you look at the Bureau of Labor Statistics, the economy added 911,000 fewer jobs during the 12 months ending in March 25 than they previously thought. There was a big revision there. Those revisions happen pretty often because the announcements come from the Bureau of Labor Statistics sooner than they have all the data. So it's not uncommon for them to go revise numbers that they've already put out. But the magnitude of the revision was what was noteworthy in this case. They were off, they were wrong by a bigger degree than they typically are. Now, there's been a lot of chatter about the Federal Reserve this year. So a couple things I'll point out to you that the story we're seeing here. The dotted red line of this chart, it's the long-term unemployment average. If you look at the green line, that is unemployment at any given time. So if you want to look at the really big spike in the around 2010, for those of you who were in the workforce then, you remember that around unemployment spike around 2020, those all make sense. But we're below that long-term average now. And when you look at the Federal Reserve, the part of the Fed that gets in the news is the Federal Open Market Committee. It's the body within the Federal Reserve that sets interest rates. And then for the first time this year, the Fed made the decision to cut interest rate by 0.25%. And now we're at a point where markets are expecting a couple more rate reductions by the end of the year. The Fed's had a lot of commentary around why they are or are not acting. One of the reasons they've said they were acting is because they saw the softening in the labor market. But they don't have an easy job. If you take them at their word, they want to balance keeping everybody at what they call full employment, but also balancing against inflation. And inflation, although it's so much better than it was in the past, it's still above the target rate that the Federal Reserve has in place and the target rate and the level that most of us would like to see it at. Still been stubbornly high. Now, Will they be able to maneuver this and get us back to that lower level that we prefer to see? Time will tell. And just one more piece on the employment front. Wanted to share a little bit about what inflation looks like when we're not just talking about goods at the grocery store. It does have some relationship with services and hourly earnings as well. When you look at that there is some effect that that has on there. Now, looking at the Federal Reserve some more and what that does for as far as impacting not just the markets but daily life as well. So let's revisit that for a moment. It's reasonable to ask, like, how does the Federal Reserve interest rate decisions that directly influence very short maturity bonds, how does it impact the entirety of all the government debt that's out there, what we call the yield curve and other interest rates? So if you look at this graphic, dating back to the early 1980s when the Fed moved the federal funds rate up or down, the 10-year Treasury yield, which is it's a closely watched benchmark rate, moved in the same direction about two-thirds of the time. That's shown in the bottom left and the upper right areas of the graph. However, the 10-year yield moved in the opposite direction about one-third of the time. This is because longer term yields like the 10-year tend to be more influenced by expectations for economic growth and inflation rather than short term interest rate decisions. So, as a result, as an example, if you're in the market for a mortgage whose rates are loosely tied to the 10-year yield, it's not a foregone conclusion that mortgage rates will decline just because the Fed lowered rates. Like ultimately, what this graphic tells a story about, the Fed does not have direct control over the longer term maturity interest rates, and that the Federal Reserve federal funds rate is not a completely reliable predictor of where long term interest rates are going to go. Impact, yes. Total control, absolutely not. Let's talk about some markets. Let's talk about bonds first. If I had this chart to show you every quarter, I would love that. I would absolutely love that. US and global bond returns were all positive for the third quarter. Over the past 3 months, corporate bonds have outpaced their treasury brothers and sisters as yields dropped over short to intermediate portions of the treasury curve. Credit spreads remain pretty tight. Municipal bonds led the pack overall as yields dropped further across the municipal curve. All bond returns shown in this graph are positive over 12 months, with the short-term inflation protected bonds earning the most at around 5.7%, with intermediate corporate bonds trailing just behind. And then a little bit more on bonds. These are the yield curves, so the yields at different levels of maturities. This is improved, but this is still what we would call a non-normal yield curve. Still what we call inverted. This is different than what you see in most economics textbooks, and that has been the case for some time. Then when we look at municipal bond market, it's much more close to what we would call normal. Let's talk about U.S. stocks. U.S. stocks were positive for the third quarter across all different size and valuation segments we look at, with small cap value stocks appreciating the most at about 12.6%. On a year to date basis, as well as last 12 months, large cap and growth stocks have led the market as tariff and trade uncertainty weighed on small caps and value stock performance to begin the year. Small cap stocks were the winner for the quarter, though. And this is a really good example of why we advocate for having diversified portfolio across different sizes of stocks. We talked about those Magnificent Seven stocks earlier. It's really easy to say, why don't I just put everything into those types of companies? This is why. The small companies don't make the headlines, but there still is value to invest there. And this quarter was a good example of why that value is there. Let's talk a little bit more about artificial intelligence. While the small cap value stocks did lead the pack for the quarter, the US stock market has been largely supported by large technology focused companies over longer periods. If you look at the chart on the right, companies have been producing massive amounts of semiconductors and other infrastructure to fuel AI growth as the next potential big technology. If you look at the chart on the left, we're now seeing eye-popping dollar figures associated with AI-related spending being announced by what some people call AI hyperscalers. Those are companies like Alphabet, Amazon, Meta, Microsoft, Google, and it amounts to hundreds of billions of dollars that are committed over the next couple of years. So if you look at the what markets are acknowledging that these big sums of capital are necessary to bring AI out to the masses, but the return on investment is going to have to be significant to match that at some point. Um, if the cost to support AI does not bring dramatic returns on the initial investment made by these companies, then there's a risk to investors who concentrate their portfolios just around this sector. And speaking of risk, let's talk a little bit about another dimension around that. So concentration risk is something that to think about when it comes to the broader US stock market. The top 10 companies in the S&P 500, as measured by the green bars on this chart, are more expensive today when we look at the 12-month forward price to earnings ratio. It's a common way to value stocks and look at them. Compared to the top 10 holdings were in the mid 90s and early 2000s around the time of the bubble. The same is true for the index more broadly, like just like the AI revolution of the 20s and the internet revolution of the 90s. It was described as generational change, and in hindsight, it's fair to say that the internet eventually delivered on its promises. While the future is unknowable, the same might be true for AI, but it's not unreasonable to expect that it might not be a completely upward march. There may be some of that fall back to earth dynamic that we saw with the rise of the internet at some point. And so, a reasonable question to ask is with interest rate changes in the news, what does that do for stock market returns? Not the answer is not a lot. The expectation that you get a lot from a lot of headlines is if rates get cut, then that's going to make a big swing on stock market. And the reality is it doesn't make that much of a difference. If you look here comparing when rates rise by greater than 1%, rates stay within about 1%, or rates fall by 1%, not a lot of difference in what we see for that monthly return from the stock market. Not that it doesn't matter for the economy. Remember, economy and stock market, while they're linked in the long run, in the short term, they can often do different things. And again, as I'm recording this, there is a government shutdown that is ongoing. A reasonable question to ask is what do markets do in response when there's a government shutdown? And the reality is it's very mixed bag here, as you can see. When we look at past shutdowns, overall, the markets have moved up, but as you can see, that's far from a rule. There are times when markets have gone up, stayed flat, or gone down. If you use history in the perfect guide, average performance of the S&P 500 during those prior shutdowns was about 0.1%. So there's not a lot to read into this other than stay the course and ignore the noise. There'll probably continue to be lots of headlines around this, and it's not the good basis for making a decision solely in reaction to that government shutdown. Let's look outside the US for what stocks did. Again, good news here. International stocks were up for the quarter, year to date, and the previous 12 months. This is another chart that I wish I had to show every single quarter. This is also a good example of why we advocate for diversifying with stocks outside of the US. If you look at the year to date, you'll see different parts of international markets in the 30% range. Just to put some perspective on this, long-term average for the markets over many years is closer to 8 to 9%. So we've essentially got, and that, said another way, that's about 3 years worth of positive return, all in a very short period of time. So although we're happy to see this, I would take this every year. A more realistic expectation is at a lower level than this for long-term returns. Doesn't mean we're not happy about it. We don't welcome it, but it's good just to put that in perspective for what that looks like and what an outstanding period of time that is for international stocks. Now, speaking of international stocks, while international developed stocks underperformed with their US counterparts for just the last quarter, they hold a substantial lead so far year to date and are on near equal footing for the last 12 months. And at least part of that has been supported by a falling US dollar. Now, as this chart shows, this is a phenomenon that's not unique to 2025. In portions of each decade from the mid to late 70s through this year, when the dollar has a broad, sustained decline compared to other major global currencies, US investors who hold investments priced in international currencies get a boost in returns. So looking at this chart, you see periods where the dollar declined and international developed stocks outpaced US stocks on a trailing 3 year horizon, sometimes 30% or more. To be fair, the opposite is also true, but this is a dynamic that can be helpful when you're particularly sensitive or fearful when you think about declines in the US dollar. Nonetheless, overall, the dollar remains strong relative to the past 20 years. And that's what this looks like. A rising dollar is generally good for US consumers as it makes foreign goods cheaper to purchase, but bad for owners of non-dollar denominated assets like foreign stocks. And here again, while we've seen a little bit of a decline in the dollar over the recent period, historically speaking, dollar is still very, very strong compared to other currencies around the world. Looking at long-term time horizon, movements of the dollar and other currencies tend to wash out over time when it comes to returns on investments. But recent valuations compared to history give clues as to where returns might come from in the future. To put it a bit more succinctly, the higher valuations are today, the lower expected future returns are during the next long-term period. This chart here shows the price to earnings ratio, a measure of how expensive stocks are at a given time for US stocks in the red versus the same for global stocks in the blue line. As you can see on this chart, when looking at the 2008 to 2010 period shaded in gray, both US and international stocks were valued roughly the same coming out of the great financial crisis. But since then, US stocks have become about 50% more expensive relative to international stocks going forward. And while anything can happen in the short term, history tells us that US stocks are unlikely to repeat their dramatic outperformance over the next long time period. And so, just to draw us to a close here, a couple reminders for you about things that we believe are very important to remember. Financial planning is a process, it is not an endpoint. We're never done. Concentrate on long-term goals and objectives, ignore short-term noise. Focus on reaching goals, not on beating benchmarks. Maintain a disciplined approach in good markets like we've had or bad markets when they surface. Invest broadly and globally. Asset allocation is really key. Reduce investment and tax costs where possible and rebalance as necessary. I want to thank you again for joining me and hope this is a help to you. I want to wish you a great day. May the Lord bless you and may the Lord bless your family. Have a great day.